You're listening to New Retirement Radio, brought to you by the team at Prout Financial Design.
Hello, I'm your host, Certified Financial Planner, Dennis Prout.
I'm Heidi Cartwright, Financial Advisor and RICP.
Advisors associated with Prout Financial Design may be either 1. Registered representatives with and securities offered through LPL Financial, member FINRA SIPC, and investment advisor representatives of Integrated Partners, a registered investment advisor, or 2. Solely investment advisor representatives of Integrated Partners, a registered investment advisor and not affiliated with LPL Financial. Investment advice offered through Integrated Partners, a registered investment advisor. Integrated Partners and Prout Financial Design are separate entities from LPL Financial. Dennis Prout and Nathan Prout are solely investment advisor representatives of Integrated Partners and are not affiliated with LPL Financial. The opinions voiced in this show program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriately qualified professional before making a decision.
WTCM News Talk 580. Welcome aboard to another edition of New Retirement Radio with Prout Financial Design. Joining us today in the studio, Mr. Dennis Prout. Good morning, sir.
Good morning, Ron. How are you on Thursday?
I'm very
November
well.
28th.
It is. Unless you're listening to the repeat on Saturday.
Yes.
But either way, fine. Thank you.
It's a repeat, not a three-peat. Thank you very much. Thank you. So joining us today, Heidi Cartwright. Good morning, Heidi.
Good morning, Dennis. It's my pleasure to be here today.
It's great to have you. Our executive director and then our managing director, Nathan Prout. Good morning, sir.
Good morning. It's great to be here.
It's great to have you. And then our director of marketing, Beth, sitting back there. Hello.
Good morning, Dennis. It's great to be here, and good morning to all of our listeners this morning.
It's great to have you. And she's got some great stats on what's happening with the economy. So that, not what's happening with the economy, but what's going on with the new contribution limits. So today, the name of our show, Bubble Trouble. There we go. What today's market signals mean for investors. We're going to dive into the question of many people are asking, are we in a bubble stock market? The big concern was around NVIDIA and their earnings announcement, which beat expectations. Their market close yesterday, they went up a bunch.
There's your
After market close, what the market is up. The Dow 30 up, almost 600 points, 586. Now, we get that these things go up and down. So for a compliance matter, we're simply mentioning NVIDIA because they're hitting the news big time. And obviously that doesn't mean an endorsement of NVIDIA. See, we have to cover cover ourselves every which way but loose. So today we're talking about what's going on with the markets, what's happening with our economy. I thought this was fascinating in terms of the global population. It's reached 8.2 billion people for the first time in history. First time, I say. Nearly half of humanity belongs to Generation Z and Generation Alpha.
Wow.
The digital native generations. The Gen Alpha folks are only 1 to 12 years of age, and then born between 2013 and 25 now includes about Gen Alpha, rather. Gen Z and Gen Alpha both together include 1 to 12, those 1 to 12. But those born between 2013 and 25 now includes about 2 billion people.
So Generation Z officially 1997 to 2012. So 97 would make you 28 on the upper end.
I could have looked at my notes further down. Yes, 97 to 12, right.
Oh, you've got them right there. Okay.
Gen Z, thank you, 22.9%.
So
Gen Alpha is 2013 to 2025, 24.4% of the population. So combined, those are about 50%.
Almost half of the world's population is under 28.
That's kind of scary.
It is.
That surprises me because I really didn't. That just surprised me.
What happened to everybody?
Yeah.
And
what
or
happened?
This birth thing. What's interesting is I have always thought as the baby boomers as the major generation. Well, it only represents 12.8% of the world's population. Thus, Rob says, our own economist, we are on the precipice of great change. One way to make sense of the change is to plunge into it. He goes on with some talk about that. But anyway, what's happening is the Gen Z generation, Gen Z and Gen Alpha, have a very different attitude about investing. They're saying that they tending to think much longer term and much more market orientated, asking much more pointed questions about the economy and their own opportunities within it. There was a Barron's interview done on 11/8 of 25. Most people would say that's November 8th. Thank you very much. With a Mr. Sonu Kalra of the Fidelity Blue Chip Growth Fund. This is no, thank you. This is no endorsement of the fund. It's simply saying that he was interviewed by the Barron's. He has managed the Fidelity Blue Chip Growth Fund since 2009. He often scouts for investment ideas and battle tests them by monitoring the habits of his teenage children. That's interesting. He says, I'm a big believer that the future is being shaped by younger consumers who are early adopters of technology. Isn't that the truth? And trends that can drive sustained growth. Fidelity Blue Chip Growth has benefited from this approach, having returned over 18% on average over the past 15 years. That's 18% per year. Yes. Outperforming 96% of its peers, according to Mr. Morningstar. It could be Ms. Morningstar as well, just to be even-handed about it. So, Barron's, there's a couple of questions here I thought would be very interesting for you all to hear. By the way, if you'd have a question of a financial nature that you'd like answered, our number, if you would, Ron, is?
You could call us or text us, 947-0023, 947-0023, 231 area code.
Cool, thank you, Ron. So Barron says to him, many investors like you have been captivated by AI-related stocks, although there are now concerns about the amount of AI spending. As an example, 3 Mile Island is now going to be coming back on board.
Wow.
3 Mile Island that was shuttered 30 some odd years ago. Microsoft is agreed, I think it's Microsoft.
I don't know.
I think it is. That has agreed to buy all the power generated for the next 10 years from 3 Mile Island. They say, how do you envision this technology's trajectory? Mr. Kalra says, AI is the fourth tech wave I have seen in my 25-plus year career. Fourth one. There was the internet in the late 90s, the smartphone in the 2000s with the iPhone's launch in 2007, and then cloud infrastructure in the 2010s. 2010 plus, we'll just say it. This latest wave, generative AI, really started with ChatGPT's launch in November of 22. That is when AI came to the masses and had its iPhone moment. I think of generative AI as converting investment dollars and energy into intelligence. The goal is artificial general intelligence. There are about 100 million knowledge workers in the U.S. and about 1 billion globally now. Stay with me on this. I thought this was really interesting. His theory about this. He says if you assign some sort of value to each worker, let's say $100,000 to make the math simple, and you believe that AI can drive 10% productivity, that implies $1 trillion of value in the United States and $10 trillion globally. That is why he says, I'm a believer.
So what does that mean, productivity? I always thought productivity means, well, you're saying all of those workers would still be employed. They would just be more productive.
Well, they would be employed at whatever it is they're doing. It doesn't mean they're going to have the same job, obviously.
But I'm just wondering if productivity increases, would that also result in job loss?
It could.
It could.
Well, it certainly will. I'm not going to say it could. Just thinking about it for a moment.
Yeah.
It will mean job loss, but it also means job gains. So for those who are willing to migrate or able to migrate, perhaps, that's where the benefit is. And that's what happened in the early 2000s. Those who were able to migrate with a new technology and embrace it tended to prosper. So there is an element of change going about there. The proverbial cheese being moved. It is going to be moved and big. So he says that's why I'm a believer. Now, what parallels, they say, if any, do you see in the dot-com bubble of the late 90s? In the late 90s and early 2000s, he says, dot-com related stocks went through a correction and digestion phase. But in the next 20 years, the internet became embedded in everything we do, creating value over time. That is the roadmap I'm using to think about generative AI. I'm a believer in futurist Roy Amara's law. We tend to, and this is a great quote, I think you'll find helpful. We tend to overestimate the impact of technologies in the short term, but underestimate them in the long term. And that's why the amount of investment companies are making in AI and in its generation. What NVIDIA said, Mr. Huang was, Jensen Huang is the CEO of NVIDIA, was that the amount of orders, in essence, that they've got is almost overwhelming. They are working and going as fast as they can to satisfy the bigger and bigger need for faster and faster computer chips. So they've basically sold out of their supply.
And by the way, you're right on Microsoft. They partnered with Constellation Energy to restart the Unit 1 reactor at 3 Mile Island, the nuke plant, and that will power up Microsoft's data centers.
Yeah, and Beth has got some fantastic note. Do you mind reading that right now? The total number, were you the one that had that stat of data centers?
No.
That's
Who
in
had
my
that?
heart.
That was Heidi's. See, Dennis gets confused quite easily, but Heidi, could you read that, if you can find it, locate it, the number of data centers in these United States? It's crazy.
The U.S. currently has more than 5,400 data centers, which is more than Germany, the U.K., China, France, Australia, the Netherlands, Russia, Japan, and Brazil combined. So,
Booyah.
So we've got some amazing infrastructure still here in these great United States of America, and this reinvestment that's going on, that is an amazing thing to watch. The amount of dollars that are being reinvested in our own economy to power the future it's an exciting time to watch. Now, always there are concerns, the change, what's this going to do? How do we control it? All those tend to be things that shouldn't be discounted. But at the same time, we can say, what are the opportunities? Given the opportunities for speed, for efficiency, for how it can change careers and make all of us that much more efficient, it'll be a challenge to keep up. And stay
Two-edged
ahead.
sword, though. People are putting videos out there, and they're AI, and they're
Yes.
totally not true. Looks like real people. They're saying things that's not really them. There's
Yes.
a lot of downside.
Yes,
But I was going to say,
right.
with the data center plant, there's a fellow who is holding hearings this week in Kalkaska. He says would be a perfect location, a few miles west of Kalkaska, and it would need its own natural gas plant to power it up.
Wow.
But what he does is carbon sequestration, so all the carbon that comes out of the natural gas plant, he captures it and puts it down into the ground in a well. So he's saying that Kalkaska has everything to accomplish that. It would be a carbon-free data center, but huge,
Wow.
huge, gigungous.
Wow.
That's really interesting.
Yeah. So I guess those things, they suck up a lot of power.
They do.
Yeah.
Yeah, it's tremendous what the needs are. And that's only one of many issues that they're going to have to solve, but they're working diligently and quickly, it would appear. It's, the right now, the opportunity seems to be almost limitless, which it never is. There will be corrections, of course. Heidi's next, talking about Made in America making a comeback.
That's
and
right.
A huge one. Yeah.
Yes. And this is an article coming to us from Capital Group. It is written by 5 different portfolio managers and analysts at Capital Group. So Made in America is a political slogan and a marketing strategy used throughout U.S. history. Going back as far as the Revolutionary War, the homespun movement encouraged colonists to make their own blankets and clothing in a symbolic resistance to the British economic control. So this is not a new idea, it's an old idea. So it should be no surprise that the deeply rooted tradition is gaining momentum. There is a push to bring back manufacturing to the United States. The goal is to reindustrialize, at least partially, a nation that abandoned the manufacturing sector decades ago. So far, there are concrete signs that it is happening and may continue to gain momentum in the years ahead. Given labor and regulatory bottlenecks in the U.S., the authors think that the reshoring trend is going to take many years to play out, and that is why they see it as a tailwind that could be with us for a long time. There are 3 areas where progress is being made to rebuild a long-neglected segment of the domestic economy, and the first area they talk about is companies that are responding to the carrot and stick approach. So the Trump administration has used a combination of incentives and penalties to encourage companies to invest in the new manufacturing effort. The carrot and stick approach, with tax incentives being carrots and the tariffs being sticks. This year alone, U.S. tech giants such as Apple and NVIDIA, as well as non-U.S. U.S. companies such as AstraZeneca, Taiwan Semiconductor Manufacturing, and Hyundai, have announced multi-billion-dollar plans to establish or expand their U.S. operations, making computer chips, pharmaceuticals, and automobiles. Just last week, NVIDIA said it is now manufacturing its most advanced computer chip, known as the Blackwell platform, entirely within the United States. In targeted sectors related to national security, the reindustrialization of the United States is achievable. It will just take time and constant bipartisan effort, and that is a comment from one of the analysts at Capital Group. Other sectors, such as automobiles and electronics, may be more difficult to achieve. So then they move on to their second point, which is the AI boom is driving U.S. manufacturing growth. And like Dennis talked about earlier, all of the areas where companies have made commitments to invest in the U.S. manufacturing, artificial intelligence is by far the most impactful. The AI boom has spawned a massive construction effort, building data centers across the country. And like I mentioned earlier with Dennis, that's where we got that 5,400 new data centers that far outpaces many countries in the world. The AI building spree is effectively spreading tech sector wealth to companies in the industrial sector. For example, a maker of gas turbines and transformers, GE Vernova, recently reported that it has a 3-year backlog for orders for equipment.
Ron, if you're thinking of ordering a gas turbine, I mean, you're just going to need to forget about it, okay?
You just have
That's
to get
one
in
of the
line.
companies. The Saudi crown prince was at the White House, 2 days ago? And said he's
MBS.
going to invest, MBS is going to invest $600 billion to $1 trillion in this country. A lot of it's going to Greenville, South Carolina, where GE, what's it called? GE Vernova is located. They're going to, 1,800 new jobs there.
Wow.
Yeah.
That's exciting.
Vernova.
Good to know.
So this data center expansion has created a great divide in industrial markets between the haves and the have-nots. The haves are the companies with businesses tied to AI data centers, in addition to aerospace and defense. The have-nots are essentially all other industrial firms, including those connected to agriculture, trucking, housing, and commercial office space. What we are seeing so far in terms of the reindustrialization of America has been the industrialization of AI. So then they move on to their final point, which is critically needed drugs are on the way. Pharmaceuticals are one of several areas where it may be difficult to shift large-scale manufacturing back to the U.S., particularly for certain key medical needs. This was a harsh lesson that we learned during COVID-19, when supply chains broke down, and for a time the U.S. struggled to obtain important drugs and other medical supplies. In the realm of antibiotics, for example, China dominates the global market as the lowest cost provider of critical drugs used to treat bacterial infections. In perhaps the most extreme example, the country supplies 95% of U.S. ibuprofen imports, giving it a near monopoly on a treatment for pain, fever, and inflammation. And that was sort of surprising to me how high that was, 95% that we depend on China for. Johnson & Johnson announced in July that it will spend $55 billion over the next 4 years to build 3 new drug manufacturing complexes in the U.S. and expand several others. That same month, AstraZeneca committed to spending $50 billion on a new facility in Virginia. In June, unveiling an initiative called Lilly in America, Eli Lilly pledged to invest $27 billion to build 4 new facilities dubbed megasites.
So, Dennis, did your new facility cost $10-20 billion? I mean, what do you get for that? Isn't that a huge amount of money for a facility?
Isn't it amazing?
Billions of dollars?
How much money?
Jeez.
Yeah, if a high tech, I don't even know what the square footage cost is of a pharmaceutical firm or what it's gonna pay.
Right.
But if it's $2,000 a square foot,
They must.
yeah, they're huge. They're huge.
You think
facilities.
there's profits there in that pharmaceutical industry?
Yeah, I would say so. Yeah.
Jeez.
Yeah,
It's sort of a new industry. We'll see how it plays out.
we all need our legal drugs, don't we? Yes. Yeah.
Yeah, so they just conclude the article saying they don't think that the U.S. will reemerge as a manufacturing powerhouse. We gave that up. We gave up that capability a long time ago, but they do think that the U.S. will become more self-reliant, particularly when it comes to critically important products such as computer chips and pharmaceuticals. It is a difficult endeavor because the U.S. is seeking to reshape the path of global trade. So
It's amazing. What Taiwan Semiconductor, Heidi mentioned that briefly. I think it was $500 billion that they agreed to invest in these United States of America about 3 months ago or so.
Yeah.
In a meeting they had with Trump. So it's a humongous amount, to use a technical term, that these many foreign companies and countries are investing in these United States because it's still a relatively good opportunity. And what the employees or the people who are working at these facilities, that and including shipbuilding out east was another great example of what's going on with that. Now, do we need to take a break, Ron?
Before we do,
Yeah.
I have a question for the panel texted into us today. What percentage of income do you suggest putting into a 401k?
Well, given that you've got your credit cards paid off first,
Okay.
because you can't beat the cost versus the return of that, and relatively good with emergency funds, that sort of thing. If you can put at least 10% of your income into a 401k, that is a great marker. If you have to start with 5, start with 5. Now, the other part of that is, should I put it into the 401k Roth option or the before tax option? That's partially up to you and what your income is. Keep in mind the cost of paying the tax up front. usually has been well worth the benefit of having that money come out tax-free. That's the 401k Roth option. Okay.
But you're suggesting in general, if you have credit card debt you're paying down, you're paying
Yes.
interest, pay that before you start putting money into
Exactly.
the 401k. Okay.
Yeah.
Very
Because
expensive
that
debt.
costs 15 to 18, 20%, whatever, for credit cards.
Yeah.
Yeah, you want to pay that off first before you up the amount that you're putting in your 401k.
And maybe a good first goal is to put in enough to get the full employer match if you have an employer match, because that's a way of doubling your money, putting in up to that match. So that can be a great first goal, and then you can move on from there.
Yeah, doubling your contribution. In essence, if they're putting in 3 and you've put in 3, obviously that's turning into 6. Mr. AI Bubble Man, what do we have there, sir?
Yeah, so this article comes to us from American Funds, and it is by Chris Buckbinder. But he opens up with asking the key question is whether the appropriate analogy right now is the year 2000, which would imply that we are in a bubble that could be about to burst, or 1998, which would imply that we haven't seen the major inflection point yet, and the market may still have room to run. Keeping in mind, of course, NVIDIA beat earnings yesterday, and they are running nicely so far today. So while I acknowledge the difficulty of assessing bubbles with foresight, I believe we are closer to 98 than 2000. As some may remember, 1998 was the year that Global Crossing, the defining company of the fiber build era and one of the linchpin stocks of the late 90s bubble, came public at $19 per share. 9 months later, it was trading at $61. WorldCom famously reported that internet traffic was doubling every 90 days. Of course, both companies later went bankrupt.
Oh.
Anybody remember the name WorldCom?
Yeah.
Oh, that goes back a ways, doesn't it?
Yeah. That's back when they had modems, I think, before they had broadband.
Dial-up.
Dial-up,
When was
I remember.
Enron?
Enron, I think, was sometime later, but I'm
Okay.
not quite sure.
All right.
Yeah, I do remember the name. I think they were in energy. I'm joking.
So both companies later went bankrupt, but not before staging a spectacular run. From the time Global Crossing went public on August 14th, 1998, until the market peaked on March 10th, 2000, the tech-heavy NASDAQ 100 index rose more than 245%. Sitting out that period was very painful for experienced portfolio managers who were skeptical about the growing bubble as they were left behind by the market rally. They were ultimately vindicated in 2000 and beyond, but the journey was unpleasant.
Enron went bankrupt in December 2 of 2001. So
Yeah,
they're right in the middle of all that.
Yeah. So will history repeat itself? Down the road, I think there's substantial probability that we will see a bubble at some point, followed by a potentially gut-wrenching correction. But I don't think we are there yet. History may rhyme, as Mark Twain once supposedly said, but it doesn't repeat itself exactly. Today we have a much more robust set of companies making AI-related investments. The giant hyperscalers, the providers of internet and cloud platforms, such as Amazon, Microsoft, and Alphabet, can support their massive capital spending far better than the telecom upstarts of the late 90s. Some economists say the spending on AI-related investments, which include purchasing advanced chips and building massive data centers, has helped keep the U.S. economy out of a recession this year. By some estimates, the AI spending cycle is so large that it accounts for roughly 7% of U.S. gross domestic product, or more than $2 trillion. This enormous spending is necessary in the view of the big tech incumbents if they are going to avoid being disrupted by the younger upstart AI companies. As long as companies such as Amazon, Microsoft, and Alphabet see AI-related spending as existential, I believe they will continue to invest, and that will continue to fuel the AI boom. So right now, the missing piece is the pending IPO boom. Another significant difference today is that we haven't seen the leading company of this era, OpenAI, go public just yet. And OpenAI launched the latest round of investor enthusiasm in November of 2022 with the unveiling of ChatGPT, an AI-powered chatbot that became the most downloaded app in history at the time. Other innovative startups, including Anthropic, Cohere, Mistral AI, and XAI, remain private as well for now. We haven't had our global crossing moment yet, but I believe it's just a matter of time before these startups enter the next stage of their growth through the initial public offering process.
It's pretty interesting. I think you could look at several different areas that might be an overbuild. One of those that's been shared with us is the data center build out. That could be something where we see huge correction on the down because they've overbuilt. Mm-hmm. So while in the process, of course, of this whole infrastructure change, we could see, of course, overbuilds in some areas.
Yeah. So one of the elements that inflated and sustained the 90s tech bubble was accelerating revenue growth with promises of profitability later. These pre-IPO companies are the modern-day equivalent. When they eventually go public and investors get a more detailed glimpse into their financials, high growth rates are likely to be rewarded by the market. In addition, it's worth noting that the U.S. Federal Reserve is currently engaged in a rate-cutting cycle. Loose monetary policy can provide a tailwind for high-valued technology stocks. In 1998, Fed officials started slashing interest rates aggressively after the collapse of long-term capital management. They maintained low rates amid widespread fear over the year 2000 bug. Mm-hmm. Today, you could argue that tariffs and a weakening labor market are the equivalent concerns prompting the Fed to take action. In any case, then as now, there is a great deal of liquidity in the system, and that tends to fuel the animal spirits of investors.
The animal spirits. I like how they put that.
Yeah. So getting to the question, of course, that everybody wants to know, what if the AI bubble is about to burst? Another lesson I've learned from 3 decades of investing is that the market will humble you at times. It's entirely possible that I am wrong about the scope and timing of an AI bubble. In my portfolios, I am investing like we are somewhere in 98 or 1999 with the intent of fully participating in the powerful AI trends as they continue to unfold among these dynamic, growth-oriented companies. However, I am also playing defense, seeking to add some degree of balance to my portfolios. So in that light, he is actively looking for companies that may be out of favor today, but could do relatively well if the AI bubble pops. So he thinks energy and cable companies might fall into that category. Both of these sectors are trading near historically low valuations, and both contain select companies with decent earnings, valuable long-term assets, and the potential for upside surprises. So he is not ringing any alarm bells, but this is how I am hedging against AI-related risk in my portfolios. So looking ahead for bubble trouble, none of my comments should be construed to think that I am unconvinced about the rapid advancements in AI and its potential to be an incredibly transformative technology. I am not an AI skeptic. I believe it will change the world just like the internet changed the world. I believe it will set the stage for the creation of new, innovative, and disruptive companies, the same way the advent of the internet paved the way for Amazon, Alphabet, Meta, and Netflix. But I also think it's important to assess where we are along the path of AI adoption investor enthusiasm, and the possibility that there will be trouble ahead. If we are on the way to bubble territory, then it really matters where we are on that timeline. I would argue we are closer to the early stages, and if you look at the history of the late 90s tech bubble, then you may reach the same conclusion as me, that it's probably too early to let the risk of bubble trouble overcome the compelling opportunities presented by this powerful new technology.
And isn't that interesting? Always the importance of diversification and looking at those areas that are significantly undervalued right now. It could take 2 to 3 years for energy to come back in terms of its price or its multiples. But at the same time, it could present an opportunity given its low price. And we have a couple of questions, Ron.
You do, from actual listeners. Looks like I inherited an IRA year 2 and beyond. Is the RMD the required minimum distribution? Is that recalculated each year? If so, on deceased age, etc., or is it now based on the heir's age? So, did we get all that?
Well,
Enough to answer?
there's some missing pieces in the information we would need to have, but in general, if the person you inherited the IRA from was taking RMDs, then you continue to have to take RMDs, and then you have to have all the money out of the IRA by the 10th year following the date of death. So it does.
If they died at any point after 2020.
Correct.
Yes.
But if you died before 2020, there's a whole different set of rules. So it makes a big difference, and that's why it's hard to say for sure. But yes, RMDs do change every year because they're based on the balance in the account.
That would have been on the before the Secure Act. That
Yeah,
is
2020,
what we're referencing.
yeah.
But most likely, given just inherited 2 years ago, that's not going to be the case. And it
Right.
does, as you say, have to be emptied after the end of the 10th year, or by the end of the 10th year after the year of death. So, and if, as you say too, if the deceased owner was taking required minimum distributions, you have to take at least as much as they were taking according
In years
to the
1
rules.
through 9.
Yes,
So
in
that,
years 1
that
through
person
9.
texted they were taking, I assume the deceased was taking RMDs, and it said, I took first year. I guess they took RMD
Yeah,
first
you
year.
have to continue in that, at least that same amount. But keep in mind, you may want to take more, given today's low tax rates, your own tax bracket, and the fact that whether or not your income's going to be higher in future. Take all those into consideration, plus whatever else may come up in terms of what your opportunities are.
So it's always worthwhile to go in and talk to a financial professional and go through all these different options, because as you can tell, there's a lot of rules.
Mm-hmm.
You mentioned you should pay off your credit cards before you invest too much into 401k, and somebody mentioned here, I don't know if this is true, but this is what someone texted, the Meyer credit card rate is 33% for good credit. Does that sound possible?
33%,
That's wild.
that's real.
I have no idea. Is
Yeah.
that possible?
Absolutely, especially
Wow.
for retail locked credit cards.
Wow.
It's not uncommon to see higher interest rates on those.
And regarding Nathan's look at the bubble there from the late 90s, someone said, party like it's 1999.
Yes, indeed.
All right, and also someone said, wondering, for year 2 and beyond, the same texture with the RMD and
Sure.
the. So for year 2 and beyond, do you have enough information to make a suggestion on that person?
You have to continue taking
has to-
at
Yeah.
least the same amount that
Yeah.
you were taking.
You have to keep
previous.
taking,
Yes,
okay.
Yes.
It gets
All right.
recalculated every year, and then everything has to be out by that 10th year after the date of death.
All right.
All right. So Beth, let's hit it,
Yeah,
shall we?
absolutely. So I'm sharing on an article from certified financial planner Robin Hartle, and she is talking about the new 401k contributions. And the IRS recently announced the new limits for 401k contributions and other tax advantage retirement accounts. In 2026, 401k contribution limit is $24,500, which is an increase of $1,000 from last year. And if you are 50 years old or older, you can stash an additional $8,000 in your 401k. And if you're between the ages of 60 and 63, which is a small window, you can make an even higher contribution of $11,250 under the Secure 2.0 Act.
Good luck trying to follow all that, right?
Right.
It's about 36,000 or so, 36.5, I think it is the max if you're in that age bracket.
24.5, 32.5,
Yeah,
43.5,
36.5. That's what.
No, the 11,000 doesn't add to the catch-up.
Okay.
It includes the catch-up.
Yeah.
Oh, that's
Yeah.
It's very confusing.
Just to make things super, incredibly clear.
But only if you're one of those three ages.
so the base contribution is 24.5. You said, Beth.
Yes, 24.5.
and if you're over 50, you can put in an additional $8,000 a year.
Correct.
But if you're between the ages of 60 and 63, it's 11,250 or 11,500?
Correct. 11,250.
Yeah, so it's 36,250, just below 36,000. Either in any event, I mean, you can put significant amounts into these 401k plans. The major advantage is that you're investing every month. You're dollar cost averaging in. You are cutting the risk generally, as long as you invest throughout the cycle, the ups and the downs, significantly. Generally improving your rate of return. And the great way to invest into a Roth is by dollar cost averaging as well.
Yes, indeed.
And you're doubling your money in your 401k.
From what?
From the match?
Employee.
you're talking?
Yeah.
From the match, Given the match, whatever the match
Well,
is, up
yes,
to your own contribution.
right.
Yes, you're doubling your
Yes.
contribution itself.
Some funds.
Yeah, so it can be an incredibly efficient way to save. Now, you can do this on your own, if you like, by putting money in every month. Even for those, let's say, 82 years old, you want to improve your rates of return, considering investing still monthly. It's never out of style. It's never out of style. So it can work.
It's never on this.
Isn't that nice to know? Yes. Yes, this old thing I'm wearing is still in, or whatever. Yeah,
Everything old is new again.
it certainly can be. Now, in a couple weeks, we're going to have Ed Slott on. When is Ed coming on?
That's
Beth?
December 11th.
December 11th.
Yes.
Ed Slott coming on. He'll be calling in. And then next week, is it next week? No.
The
after.
4th.
The 4th, Rick Stewart is coming on. He's going to be talking about the program New Hope is doing, their Journey tour out there at New Hope for Christmas.
That time of the year
There
already.
we are.
Can you believe it?
Obviously, next week is Thanksgiving. We will not be live and in the studio. We'll be cooking or doing whatever. Along
We're all
with
going to
everybody
Nathan's
else.
house next week.
Woo!
Birthday.
Happy Thanksgiving.
Bring your own chair.
Brisket is a tradition.
Yes. Enjoy your Thanksgiving, all, and thank you for listening.